All right, let's get right into it. We're about to pull back the curtain on one of the most critical concepts in trading. We're talking about that constant battle you see on the charts, the fight between a real, genuine market move and a deceptive trap set to catch everyone on the wrong side. You know the feeling. Price rushes up to a key level, and you're sitting there asking yourself that one crucial question. Is this thing for real? Is it a breakout that's about to run? Or is it a fake out, a trap just designed to steal my money before the real move happens? Well, by the time we're done here, you're gonna have a solid framework to answer that exact question. So here's the game plan. We'll kick things off by defining the two core moves, what we call the grab versus the break. Then we'll map out the liquidity landscape where all this action takes place. After that, we'll learn how to spot a reversal, build a concrete action plan you can actually use, and wrap it all up by shifting our entire way of thinking into the smart money mindset. Okay, let's get to the heart of it. When it comes down to it, there are really only two things that can happen at a key level. You either get the trap or you get the confirmation. And trust me, being able to tell the difference between these two, well, that's everything. First up, let's talk about the trap itself, the liquidity grab. Now, you've probably heard other names for it, like a stop hunt or a liquidity sweep. They're all the same beast. It's the sneaky move where price just pokes its head past a key higher low, triggers a ton of orders, and then slams back in the other direction. It's a classic trap. So why do these even happen? It's actually pretty fascinating. You see, huge institutions can't just slam a buy button for millions of dollars. The market can't handle it. They need sellers on the other side. And where do they find a big pool of sellers? Well, they hunt for all the stop-loss orders that everyday traders, like us, predictably place just above highs and just below lows. Price is literally engineered to raid those levels, trigger our stops, and create the liquidity the big players need to get into their positions. So how can you spot one in the wild? You gotta look for the clues. First, it's usually a really fast, sharp stab past a level, but there's no real follow-through. It just kind of hangs there. And then you see it. A strong rejection, often leaving behind a big, ugly wick on the candle. And the final nail in the coffin is when price snaps right back inside the old range. That's your big red flag that a trap has just been sprung. Now, on the complete opposite end of the spectrum, we have the confirmation, the break of structure, or BOS for short. This is the real deal. This is when price doesn't just poke through a level, it smashes through it, and this is the most important part, it closes with a strong candle body on the other side. This is the market telling you, hey, this momentum is real, and we're probably gonna keep going. Unlike that weak little stab from a liquidity grab, a real break of structure has some muscle behind it. You're looking for a solid candle body to close past the level, not just a wick. You'll see actual follow-through on the next few candles. And very often, price will come back down to retest that level it just broke, and it'll hold before taking off again. So let's put them side by side, because this distinction is what it's all about. A liquidity grab sweeps a level and then reverses. A break of structure breaks a level and continues. One is a trap to take traders' money for fuel. The other confirms that the trend is strong. The trap is fast, sharp, and full of rejection. The confirmation is sustained, structured, and has follow-through. See the difference? Okay, so we've got the trap and the confirmation down. But you know, these things don't just happen in a vacuum. To really get it, you have to see the market as a kind of battlefield, where price is always moving from one pool of liquidity to the next. So let's map out this battlefield. Just think of liquidity in two main types. First, you've got external liquidity. This is the big prize. It's sitting at those major, obvious swing highs and lows that everyone on the planet can see on their chart. That's the ultimate target. But to get there, price needs fuel, right? And that's where internal liquidity comes in. This is the smaller stuff, the little highs and lows inside the main trading range. And this is where it gets really clever. Smart money will often go after those smaller pools of internal liquidity first. They'll sweep those little levels to build up their position and gather momentum before they make the big explosive move towards that external liquidity target. If you understand this, you won't get faked out by a small internal sweep thinking it's a major reversal. And that brings us to what I think is the most powerful signal of them all. This is the one that actually combines the trap and the confirmation to give you a heads up that the entire trend might be about to flip. It's called the market structure shift, or MSS. So what on earth is a market structure shift? Simple. It's a very specific two-step sequence. It's the earliest reliable sign you'll get that a reversal might be coming. And here's how it works. Price first does a liquidity grab at a key level, and then it turns around and breaks structure in the opposite direction. The order here is absolutely critical. The very first thing you have to see is that hunt for liquidity. Price sweeps a major high or a major low, taking out all the stops that were resting there. Then, and only after that liquidity has been grabbed, do you look for part two. Price has to move with conviction in the other direction and create a clean break of structure against that old trend. And once you get that 1-2 punch, the liquidity grab followed by the structure shift, the most likely thing to happen next is expansion, a powerful, sustained move in the new direction. Now, let's be crystal clear on the difference here, because it's huge. A market structure shift is a signal of a potential reversal. It's that two-part sequence we just talked about. A regular break of structure, or BOS, on the other hand, is usually a signal of trend continuation. It's just a single, powerful move that says, yep, we're still going this way. Okay, theory is great, but let's get to the important part. How do you actually turn this into a plan? How do you trade these ideas without falling into the very traps we're trying to avoid? Let's build an action plan. Here's a simple 4-step process. First, you identify a key swing high or low where you know liquidity is sitting. Step 2, and this is the hard part, you have to be patient and wait for price to actually sweep that level. Don't jump the gun. Step 3, look for your evidence, a strong rejection candle. And finally, step 4, the safety step. You wait for a break of internal structure back in the other direction. That's your confirmation to act. Listen, this is so important. The single biggest mistake traders make is trying to be a hero. They try to call the exact top or bottom, and they enter while the sweep is happening. You will get steamrolled doing that. The professional way is to let the market show its hand first. Wait for confirmation. Patience really is everything here. You know, when you really master these ideas, it's more than just a new strategy. It fundamentally changes the way you look at a chart. It's about a total shift in your perspective. So let's wrap it all up with a quick cheat sheet. The liquidity grab, that's the trap. The break of structure, that's your confirmation. The market structure shift, that's your reversal signal. Internal liquidity is the fuel, and external liquidity is the final target. You see? Instead of just chasing breakouts, you start looking for where the traps are being set. And really, that's what this is all about. This is the goal. It's about making that conscious decision to shift from a reactive, retail mindset that always falls for the bait to a patient, strategic, smart money mindset that waits for the market to prove itself. Make that one shift, and I promise you, you will never look at the charts the same way again.